Hi everyone, welcome back to my channel Sugar Mama TV. If you haven't already subscribed, please make sure you do so right now because this is where you build your level of financial knowledge and education so that you can make more informed decisions when it comes to managing your money and actually see your financial wealth build and actually realize that financial security and independence is well within your reach when you make great decisions with your hard-earned money. Alright, today guys, I'm talking to you about passive income streams. There are a whole range of different passive income streams, some which are very conservative, some which are quite aggressive. However, it's important that you pick the right income stream for you and for your financial goals and for your risk appetite. Now, for people who are really nervous when it comes to investing and don't have much experience, they may want to start off investing in fairly conservative styles of passive income sources. And these are typically cash, savings accounts, term deposits, maybe even some government bonds or even corporate bonds. And typically because they're more conservative, their returns are a little bit lower. They're typically a passive income stream, that is the yield of these conservative types of investments ranges between 2 up to 3.7% per annum. But these types of conservative assets generally have no capital growth. They're predominantly income based, which means if, for example, you bought a bond for $100,000 and the yield was, say, 3%, you would be getting only $3,000 a year in passive income from that bond. There is no capital growth element to it whatsoever. But if that's right for your risk profile and you don't like taking risk and you're uncomfortable with it, that may be the right type of investment for you. Now, the more aggressive or assertive, you could say, investments for building long-term wealth are things like residential property, commercial property, domestic shares, or international shares. And these returns are typically, as history shows, a lot higher because the more risk you take, the more of a reward you should get. So residential property on average yields between 3.2 up to 3.9%. But when you take out all the expenses of running a property, it typically comes down to a yield of around about 2 to 2.5% per year. With commercial property, the yield tends to be a little bit higher, around 5.5%. And when it comes to investing in shares, depending on where those shares are based, for example, Australian shares, the yield tends to range between 4.7% up to 5.7% when you factor in franking credits. Now, there seems to be a lot of misconception when it comes to investing in shares and comparing it against conservative investments such as fixed interest bonds. However, I want to make sure you guys are aware of the difference between these two different types of asset classes and the impact over the long run. So the best way for me to show this to you is by showing to you what has happened in history. If I was to take $100,000 and put it into a term deposit in 1979 and just took the passive income each year and spent it, I never reinvested the money or added any new money to that term deposit account. By 2016, that $100,000 would still only be worth $100,000, but it actually would have eroded away because that $100,000 cannot buy me what it can today is what it could have done in 1979. And I would still be earning a passive income of $2,500 per year. That's it. However, if I put that $100,000 into a diversified share portfolio of Australian shares, again, just taking that passive income through the dividend yields and spending it, adding nothing to it and not reinvesting any of my dividends, that share portfolio would now be worth $1.12 million. And the passive income that I would be receiving from that $1.12 million share portfolio would be worth over $51,000 every year. Now, I'm pretty sure you would rather be receiving a passive income stream of $51,000 a year versus $2,500 a year. So you're probably wondering, how is this possible? How is the same amount of money invested in two different asset classes with not too dissimilar yields over the long run so incredibly different? Well, it comes down to the fact that shares are two-dimensional assets. They not only do they produce income, they also produce growth. And that income grows with the capital value. With shares, when a company raises profits, they reinvest some of those profits back into the business for future compounding growth and to expand and improve the value of the business, and then they pay a dividend on that. And that dividend grows every year as long as the company grows. Now, a lot of people say, well, fine, Canna, investing in shares is incredibly volatile and comes with a lot of risk. And yes, you are correct. You do, when you invest in shares, there is a lot of high to medium term volatility over the short to medium term. However, when I show you this other chart, this will really change your perception of really how safe term deposits are. If we look at the yield on term deposits and compare them against shares and even commercial property, in fact, it's actually the term deposits which are a lot more volatile over that 17-year period. So that perception of term deposits being safe and you can sleep well at night versus shares being risky and dangerous isn't actually quite true. So what this boils down to you, if you're trying to build up a passive income stream, you've really got to look at the underlying assets in your portfolio. You do not want to forego long-term growth for stability. You need to make sure that your passive income and your investment portfolio is sustainable. It's going to provide you with that passive income that's going to grow over time and ensure that you remain financially independent. Do not fall into the trap of just going and investing purely for yield with no capital growth. This will come with a lot of regret further down the track. And if you're going to build up an investment portfolio where you're going to incorporate more of these growth style investments such as international and Australian shares and even some property, make sure you diversify. You do not need to go all or nothing. Most people have a diversified share portfolio where they may have some commercial property, some residential property, a mixture of Australian shares and maybe some international ETFs. It's a really well diversified portfolio which smooths out the overall volatility over the long run. And of course, make sure that you look at the yield, but make sure that the yield is consistently growing over time. These should be the foundations of what you look for in a quality investment. Now, as you're watching all of my Money Monday videos, I really hope that you're starting to get a bit more interested and a bit more inquisitive and maybe even tempted to start building up a share portfolio. But please remember, you do not need to stress about which shares to pick and where and how and what. You can very easily look at a listed investment company that does all that work for you, or even a managed fund that does all that work for you, or even look at a diversified ETF. There are so many different investment options out there. You do not need to put the stress and pressure on your shoulders as to what stocks to pick, when, how, and why. This can be outsourced to a professional. All right, everyone, I really hope you've enjoyed this video. Remember, invest for the long run, invest for long-term capital growth and long-term growing yields. That's the key foundation to building healthy, strong, passive income streams. Ciao for now. If you haven't already subscribed, please make sure you do.